Today, we are plunging into something, well, pretty fundamental, what happens inside our heads when we deal with money.
Yeah, it's this fascinating intersection of your brain and your wallet. Super important stuff.
Because, let's be honest, our brains are amazing most of the time, right? Daily
Yeah.
life, navigating social cues,
Totally capable. But then you throw finance into the mix.
and suddenly it feels like your own brain is working against you sometimes.
Exactly. Which is why we're diving into Jason Zweig's book, Your Money in Your Brain. How the new science of neuroeconomics can help make you rich. Really eye-opening.
So our mission today is to unpack those key insights. What's going on in that internal battlefield between, logic and emotion when you make financial choices?
Because knowing the right answer on paper,
Yeah.
that's one thing. Actually doing it when emotions are high, that's completely different.
And Zweig nails this core tension right away, these ancient emotional parts of our brain, the ones built for survival over millennia.
They just aren't really equipped for the complexities of modern markets. They can totally hijack the logical part.
So knowing versus doing, that's the heart of it.
That's the starting point. So
Yeah.
the book lays out these two main systems in your brain. You've got the reflexive system first.
Okay, it's reflexive.
Deep, ancient, totally instinctive. It's all emotion-seeking pleasure, avoiding pain, like instantly. Think survival.
Right, the gut reaction. Millions of years old.
Exactly. And then there's the reflective system.
The logical part.
Yeah, the analytical brain. It's much newer, kind of a thin layer on top. Can handle complex problems, data, future planning.
If it gets the chance.
That's the key insight for your money, that powerful, ancient reflexive system. It often just steamrolls the logical one.
And the book mentions something pretty startling here. Financial losses get processed where?
In the amygdala, the same brain area that lights up when you sense mortal danger.
Wow. So losing money literally feels like a threat to your life on a primal level.
It absolutely does. That's a huge automatic reaction to try and overcome with just logic.
And the flip side is just as intense, apparently. Thinking about making money.
Can trigger the brain's reward circuits in a way that research suggests is almost indistinguishable from being high on drugs like cocaine or morphine.
Seriously, that shows the sheer power of that anticipation, that potential reward.
It really does.
Yeah.
So, given those powerful forces, it's no surprise that our intuition, our gut feelings, can sometimes lead us way off track with finances.
Yeah, intuition is great for some things, but maybe not picking stocks.
Right. The book has this amazing story about a doctor, Dr. Harris.
Oh, yeah.
He bought stock in a company called CNH purely because the ticker symbol matched his initials. CNH.
No way. Just based on that.
Just that he had a good feeling about it. No real analysis. And the point is, he's not alone. People rely on gut feelings for big money decisions all the time.
It sounds crazy, but it points to this thing called anchoring bias, doesn't it?
Exactly. Your brain latches onto the first piece of information it gets, even if it's totally irrelevant.
Like that experiment about Attila the Hun. People's guesses were pulled towards a number from their own phone number.
Yeah. Even knowing the phone number part was random, it still anchored their estimate. Your brain just wants a starting point. Any starting point.
So overcoming that takes effort. Your reflective brain has to consciously step in and say, wait a minute, is this number even relevant?
It's like that classic brain teaser, the candy bar and gum one.
Oh, the one where together they cost $1.10 and the candy is $1 more than the gum.
Right. Your gut screams the gum is 10 cents.
But it's actually 5 cents. You have to stop and think it through, override the immediate, easy answer.
And that takes mental energy. Your brain, remember, it's efficient. Uses a ton of power for its size.
Only 2% of body weight, but like 20% of the calories and oxygen.
Something like that, yeah. So it tries to conserve energy by ignoring most things and focusing only on what seems immediately important or rewarding.
Which can backfire in finance. Like those studies by Paul Andresen.
Oh, those are fascinating. He found investors who obsessed over daily price changes. Up a bit, down a bit.
Noise.
Exactly. They traded way too much and ended up earning much less than people who focused on the price level, their total wealth, the bigger picture.
He called it the jelly bean syndrome, right? Always chasing those tiny immediate hits.
Yeah, and brokerage statements often feed right into this, don't they? Highlighting those short-term swings. It keeps your focus on the noise.
So you get distracted from the actual long-term investment case.
Precisely. Now, sometimes, a fishy feeling could be useful. Robin Hogarth suggests it might be a signal to just pause and investigate more.
But it's tricky because, as Paul Slovic found, simple, vivid messages, oil prices soaring, everyone's buying the stock, can easily hijack that emotional system,
Makes it really hard to engage the analytical brain when there's all that excitement or fear swirling around.
which ties into another huge theme in the book. Our brain's obsession with predicting things, the prediction addiction.
Oh, it's deeply wired. See something happen twice, like a stock price going up 2 days in a row.
Your brain just automatically expects it a third time.
Unconsciously, it leads to that three's a trend fallacy,
Yeah.
even if it's pure chance.
And there's that idea of the interpreter in the brain.
Yeah, Michael Gazzaniga's work. A part of your left hemisphere that's constantly trying to find patterns and create explanations, make causal links,
Even when there aren't any.
often when there aren't any. It fuels that feeling of, I can figure this market out, which is so tempting, but often dangerous.
And this prediction drive is supercharged by reward, right? The monkey experiments.
Incredible stuff. The dopamine neurons didn't fire most strongly when the monkeys got the juice reward.
But when they anticipated it.
Exactly. And especially when the reward was unexpected. The firing rate jumped massively, like from 3 times a second to 40. The brain learns to crave the anticipation more than the reward itself.
So it's the possibility, the maybe.
Yes. And this learning can happen without you even being aware of it. The author describes an experiment where his own reflexive brain learned a pattern for getting juice rewards, changing his behavior, before he consciously figured it out.
Simple sequences just get locked in automatically.
Which leads to another bias, recency bias. Whatever just happened feels like the most likely thing to happen next.
So if the market just went up, you expect more gains. If it just crashed.
You expect more pain. Paul Glimcher's research highlights this. Think about investor sentiment in late 1999 versus, say, early 2003. Worlds apart, driven entirely by recent history.
Which explains why those expert market forecasts are so often wrong, that Business Week survey.
Yeah, strategists off by an average of 16% over a decade. It's kind of amazing.
So the big question is, if nobody can reliably predict the future, why do forecasters keep forecasting, and why do investors keep listening?
It feeds that deep-seated prediction addiction. We want to believe someone knows.
And that prediction drive, plus the thrill of anticipation, that leads us straight into greed territory.
Totally. Think about Lori Zink, the reality show winner in the book.
Yeah.
Even after winning big, she still felt that pull to buy lottery tickets when the jackpot got huge.
Or Mark Twain, apparently always falling for get-rich-quick schemes after one early success.
That anticipation circuit just stays fired up. It remembers the thrill.
And the core battle here, the book says, is possibility versus probability.
Yes. Anticipating a huge win that's reflexive, emotional, calculating the tiny odds of that win that's reflective, analytical.
And the vivid mental image of winning just swamps the cold, hard math.
Beautifully put in the book. When possibility is in the room, probability hides in the corner.
That explains chasing hot trends, right? That stock that's already gone up 500%.
Exactly. Your brain's seeking system gets fixated on what might happen next. Maybe it goes up another 500%.
Right.
Rather than the high probability that the trend is already exhausted or the valuation makes no sense.
So chasing those uncertain high-flying returns, that's the hard way to try and get rich.
The really hard way. The book argues the predictable, almost boring way is actually much more effective. Cut your expenses.
Right. Fund fees, trading commissions, taxes. These are guaranteed drains on your wealth.
It's not exciting to like picking the next big thing, but it works. The book gives actual thresholds to aim for, like keeping annual fund expenses below 1% for a typical U.S. stock fund, maybe 1.5% for international. Little bits add up hugely over time.
And commissions. Wow. 2% to buy, 2% to sell. You need a 4% gain just to break even.
Plus taxes.
Yeah.
Holding investments for over a year to get lower long-term capital gains rates, that's another predictable win. These are levers you can actually control.
Unlike trying to predict the market. And it requires questioning authority, too, not just blindly trusting advisors.
Yeah, Einstein's quote about foolish faith in authority. Ask the hard questions. What's your long-term track record after fees compared to a simple index fund? The data shows most active managers don't beat the market over time.
Okay, so beyond prediction and greed, another massive blind spot is confidence. Or rather, overconfidence.
Oh, it's everywhere. You see those stats, most people think they're above average drivers.
Or better looking. Like 75% of people rate themselves above average at something.
Which is mathematically impossible. And while that optimism might fuel entrepreneurship, for investors, it's often toxic. Overconfidence consistently leads to trading too much and underperforming.
The real battle isn't you against the market.
It's you versus you, as Jack Nicholson apparently said. It's fighting your own internal biases.
Like home bias. Thinking investments you're familiar with are somehow safer or better?
Yeah, the Enron employees loading up on company stock, or people clinging to their local utility shares just because they know the name. Familiarity feels safe, but it's not diversification.
And that's driven by the mere exposure effect, right?
Exactly. Robert Zajon's research showed just seeing something repeatedly nonsense, words, symbols, brand logos, makes you like it more. Subconsciously.
Creates a feel-good vibe that overrides analysis, explains why employees pile into company stock, they see the logo every day.
Then there's the illusion of control. Doing anything, even something totally irrelevant like picking your own lottery numbers.
Or tidying your desk before making a trade, the Colonel Klink effect, the book calls it.
Yeah. It creates this false sense that you have some influence over a random outcome. Just placing the bet makes you feel more certain you'll win.
And if you hit a winning streak, that's safety conditioning.
Right. A few good trades can actually turn down the volume on your amygdala, your fear center. You start feeling bulletproof.
Which leads to taking way too much risk, thinking your luck or skill is permanent.
And then hindsight bias kicks in after the fact. I knew that was going to happen.
Making the past seem obvious and predictable, which in turn makes the future seem more predictable than it is. Like with the Google IPO, everyone afterwards knew it was a winner.
But very few were certain beforehand. This bias makes it incredibly hard to learn from actual mistakes because your brain rewrites history. Thinking like Buffett and Gates, who stayed out of the dot-com bubble despite the hype, requires resisting that powerful hindsight narrative.
So how do you fight this ingrained overconfidence? What does Zweig suggest?
Well, one key thing is to track your misses, not just your wins.
Ooh, that's uncomfortable.
It is, but think about the stocks you considered buying but didn't, that then soared, or the ones you sold too early. It gives you a much more realistic picture of your actual skill or lack thereof.
Try to quantify it too, right? Like how much better than average do you really think you are? Put a number on it.
And Christopher Davis's idea of a mistake wall, literally writing down past errors and the lessons learned, keeping those failures visible helps counteract the tendency to forget them.
And quantifying the risk of things like home bias. That estimate for putting half your retirement in company stock.
Yeah, Lisa Nolbrook figured it was worth less than 60 cents on the dollar compared to diversification, risk-adjusted. Think about financial risk, like life risk you insure against rare but catastrophic events. Diversification is a form of insurance.
Okay, let's shift gears slightly and really dig into fear. We touched on the amygdala.
Right, that instant alarm. Evolved for snakes and sudden noises, not stock charts. It's built for speed over accuracy.
But it massively overreacts to market volatility or seeing red in your portfolio.
But here's the counterintuitive part. You actually need some emotion for good decisions. That University of Iowa gambling study.
With patients who had damage to emotional brain areas.
Yeah. They ended up making terrible financial decisions. Without that gut feeling that, uh-oh, this is getting risky signal, their analytical brains just kept chasing losses, trying to logically figure out a random system. You need that emotional stop sign sometimes.
Fascinating. And fear also drives herding behavior.
Definitely. Disagreeing with the group literally feels painful, activating brain areas linked to physical discomfort.
So we stick with the crowd, partly because it feels better, safer.
Yeah, our brains tend to react similarly to the same news or events, creating shared waves of euphoria or panic, safety in numbers during the boom.
But total vulnerability when the herd turns and panics.
And we also tend to overreact to certain types of risk. Paul Slovic talks about dread and knowability.
Things that feel catastrophic, uncontrollable, or have vivid, immediate consequences.
Those feel much scarier, even if statistically less likely. The classic example is handguns versus smoking. Smoking kills far more people.
But handguns feel scarier because the risk feels less controllable, more vivid, thanks to media.
Exactly. We dread what we can't control or easily understand.
Which ties into ambiguity aversion. We hate uncertainty.
Daniel Ellsberg's paradox nails this. People prefer betting on an urn with a known 50-50 mix of red and black balls over an urn with an unknown mix.
Even if the unknown urn might logically have better odds.
Right, because the ambiguity feels uncomfortable, risky. Investors do this too. They'll pay a premium for stocks with lots of analyst coverage or very predictable earnings, seeking the illusion of certainty, even if those forecasts aren't reliable.
So given all this fear wiring, what practical steps can you take?
Well, the book suggests creating a John Candy moment. Yeah. Like Joe Montana distracting his team in the Super Bowl huddle.
Find a brief distraction when you feel overwhelmed by market stress. Go for a walk. Call someone.
Yeah, just break the anxiety loop for a minute. Another one is use your words.
Talk it through.
Exactly. Verbalizing things, asking analytical questions, activates the reflective brain and can dampen the amygdala's fear response. Ask, okay, the price dropped, but what else fundamentally changed? Are my original reasons for owning this still valid?
If I liked it higher, shouldn't I like it more now that it's cheaper? Good questions.
Question the herd too. Seek out someone with an outside perspective, someone not caught up in the immediate emotional storm.
Or even appoint an internal sniper in an investment group, someone whose job is specifically to poke holes in popular ideas.
These are ways to build in checks against that powerful fear response.
Okay, let's talk about surprise and the pain of making mistakes. Our brains don't like surprises, especially bad ones.
No, that error detection system, the anterior cingulate cortex, really fires up. It's how we learn. But negative surprises hit harder.
Which you see in the market. Stocks get hammered more for unexpected bad news than they get rewarded for good news.
And analysts often follow the price down, downgrading after a fall, confusing the price drop with a change in the company's actual value.
This pressure to avoid negative surprises leads to that obsession with hitting quarterly earnings targets, sometimes at any cost.
Like the Joseph Nacchio example at West. That short-term focus can destroy long-term value. Interestingly, firms that just meet targets often underperform those that clearly beat or even slightly miss but are transparent.
And watch out for statistical games used to hide failures, like survivorship bias.
Yeah, firms incubate new funds, kill off the losers quietly, and only show you the winners' track records.
So when someone shows you impressive average performance, you need to ask, where are the losers? What's not included in this average? History doesn't prove much when it's selectively presented.
Now, regret. That's a particularly painful emotion linked to mistakes.
What makes it sting most?
According to the research, feeling personally responsible, knowing you had other clear choices, a near miss, making an error of commission, doing something wrong, versus omission, failing to do something right, or doing something outside your normal routine.
And the endowment effect plays a role here too, right? Making it hard to admit a mistake and sell.
Definitely. Once you own something, even a simple coffee mug and an experiment, you value it more than someone who doesn't own it. That emotional attachment makes it painful to sell at a loss, even if it's the rational move.
Ties into status quo bias and inertia too, just sticking with what you have or doing nothing.
It's powerful. Think 401k defaults. People just stick with them. Often inertia is just avoidance, feeling overwhelmed or unsure. That's about 79% of 401k investors not changing anything over 2 years, despite huge market moves.
Wow, just paralysis.
And when faced with a guaranteed loss, people often flip and become risk-seeking. They'll gamble on a bigger potential loss to avoid locking in a smaller sure loss.
Like holding on to a losing stock, praying it comes back to break even instead of cutting the loss.
Exactly. Interestingly, while regret over doing something wrong, commission, feels sharper immediately.
Regret over not doing something, like missing a great investment, omission.
That tends to grow more painful over the long term.
And found money, like a tax refund.
People tend to spend it more freely, feel less regret if they waste it, because it doesn't feel like earned money in the same way.
Also, too much choice can paradoxically lead to more regret. The JAM study.
Yeah, more options led to less buying and less satisfaction.
Yeah.
Because you start thinking about all the choices you didn't make, counterfactual thinking. What if I'd picked that other one?
And the brain region involved here, the orbitofrontal cortex, the OFC.
Right. It anticipates regret. It responds not just to your outcome, but to what could have been. The more active it is, the more potential regret you feel, and that shapes future decisions.
Leading to things like selling losers too quickly just to stop the pain, or using stop-loss orders that might kick you out of good stocks during temporary dips. Murphy's Law of Investing. Extremes revert.
Okay, so we've unpacked a lot of these mental traps. Let's bring it together with some practical steps the boy offers for managing your money brain.
Yes, actionable advice. What can you actually do? First, ask tough questions when considering selling a loser.
Like, if I didn't own this today, would I buy it at this price? Or, ignoring the stock price, do I still want to own this business?
Has the margin of safety actually increased now that it's cheaper? Shifting the frame away from just the loss.
Then make inertia your friend. Use automatic investing.
Set up regular contributions, dollar cost averaging. Take the decision out of your hands each month.
Exactly. Avoid letting large sums of cash paralyze you. like the guy in the book with his bonus sitting in cash for years. Automation bypasses emotional interference.
Control your frame of reference, too. Like Zeckhauser learning to think about his AOL stock based on his initial tiny cost, not the peak price he missed selling at.
Helps manage that what could have been regret. Focus on your own goals and your own purchase price, not irrelevant peaks or what others did.
And embrace diversification. This is huge for managing emotion.
It really is. If you own a broad mix, you don't feel the sting of any single investment tanking quite so badly. You're shielded from knowing every specific loss.
What you don't know can't hurt you quite as much emotionally. Vanguard's target retirement funds are a good example. They smooth the ride.
And finally, rebalancing.
That's
Think of
it.
it as pre-committing to buy low, sell high,
Because it forces you to sell some winners and buy more losers periodically.
right? It automatically counteracts the emotional urge to chase winners and dump losers. Fear of regret makes people avoid rebalancing, but automating it or just sticking to a schedule overcomes that and can actually boost long-term returns.
So these are all great strategies for managing the financial side. But the book takes a really interesting turn near the end, focusing on happiness.
Yeah, shifting focus from just accumulating money to, well, the actual point of it all, well-being.
And the core message is pretty clear. Beyond meeting basic needs, more money doesn't necessarily equal more happiness.
In fact, chasing more money often means sacrificing the very things that do bring lasting happiness, time with family, friends, hobbies, health.
The book even suggests happiness can buy money. A positive outlook gives you energy rather than the other way around.
We also fall prey to the hedonic treadmill. We adapt really quickly to new circumstances, good or bad.
Winning the lottery doesn't bring lasting bliss, and people show incredible resilience in recovering from terrible events. We overestimate the long-term impact of both.
And the comparison complex is brutal. Comparing your wealth to others. That's a surefire way to dent your happiness, regardless of your actual net worth.
The research on spending is key too. Money spent on experiences brings more lasting joy than money spent on stuff.
Memories of experiences tend to get better over time, while the shine wears off possessions. It's the story, the connection.
There's also that fascinating idea that being lucky might be partly a skill.
Richard Wiseman's research, yeah. Lucky people tend to be more open to opportunities, more relaxed, notice more things, and have a positive attitude that attracts positive responses. Seeking novelty helps create that luck.
And impatience. That's another ancient instinct working against our modern financial goals.
Wanting the smaller reward now rather than waiting for a larger one later. It fuels get-rich-quick desires and procrastination on things like saving or exercising, where the benefit is distant and the effort is now.
But there's a hopeful note. People generally get happier as they get older.
Seems counterintuitive, but yeah. One theory is the prefrontal cortex gets better at managing the amygdala's negativity, freeing up space for positivity.
So managing emotions and expectations isn't just for better investing, it's crucial for overall happiness.
Absolutely. And the book offers some practical happiness steps too.
Like,
Simple things. Take a deep breath to find calm. Actively replay positive memories. Give unexpected gifts apparently more rewarding than buying for yourself. Address old regrets, like maybe finally taking that class you always wanted to.
be skeptical of financial pitches promising only upside, especially as you get older. Use pre-commitment strategies for things beyond just saving, like using debit instead of credit. Finding an accountability buddy.
Break down daunting tasks. Seek out novelty. And focus more on using your talents, helping others, than just buying.
It really shifts the focus. The goal isn't just a bigger number on a statement, but a financial life that actually supports feeling good.
This whole deep dive into Zweig's work, into neuroeconomics, it really highlights that constant interplay between our ancient wiring and modern financial life.
Yeah, it makes it so clear that investing success and financial well-being in general isn't just about charts and analysis. It's fundamentally about understanding and managing yourself, your own hopes, fears, biases.
And the battle of you versus you.
So here's something to chew on as we wrap up. If our brains really are wired in ways that make certain financial mistakes almost predictable, what does being a truly rational investor even mean for you?
And maybe more importantly, what's one concrete step, just one thing you'll take this week to make your brain work for your money instead of against it?